Good morning, everyone. Thank you for attending our webinar today on defending your portfolio, high quality global bonds and more. I'm Mai Platts. I'm the Director of Key Accounts and Advisor Business, and I'll be joined today by David Bassanese, our BetaShares Chief Economist. Before we start, so a couple of housekeeping rules here. So we will be recording the session and sending the slides through at the end of the webinar. And if you would like to ask a question during the session, please put it into the chat widget that you can see on your screen, and we'll try address those at the end of this session. Here is just our general advice disclaimer. So the information is general in nature and doesn't take into consideration your personal financial situation. If you would like personal advice, then you won't have to seek the services of a financial advisor. I know a lot of you are already familiar with this, but with respect to the regular content that BetaShares has available, so you can visit our website for our data, blogs, investment information. We also have our regular newsletter and insights. So Bassanese Bites is written by Dave on a weekly basis. And for those of you who are prevalent on social media, you can also keep updated on Twitter, LinkedIn, and Facebook as well. As I mentioned, it's Dave and myself who will be speaking on the webinar. So we hope that you find the session informative. So what we'll cover today is firstly an economic outlook, so what's happening in the markets. We'll do a bit of a refresh on the case for bonds in diversified portfolios. And then finally, we'll cover our newly launched fund, the BetaShares Global Government Bond 20-year ETF. So I'll now hand over to Dave to share an economic outlook.
Thanks, Maura. Thanks, everybody, for being with us today to launch what we think, or to tell you about what we think is a pretty exciting addition to our suite of fixed income funds. What I wanted to do first, really just give you a bit of an economic backdrop, and many of you that have participated in our webinars in the past will be familiar with some of this. But I guess the key point here is to highlight there are, equity markets obviously rallying at the moment. People are feeling pretty good about the economy reopening. Maybe we're past the worst of the COVID crisis. But really, there are still a lot of risks still around. That's why, having the case for bonds, at least of part of your portfolio, still makes sense. So in that regard, if you just look at the first slide there in terms of the global situation, and that's the orange line there is the global market PMI index. It's really a summary of manufacturing and service conditions across the world, covering Europe, Asia, United States, and just see the absolute sheer plummet in that indicator in April due to the government shutdowns around the world. So much worse than even at the worst of the GFC, and certainly the 2001 recession as well. Now, with things reopening again, that's probably going to start to bounce up again. But whether we get all the way back up to that 50 to 55 zone anytime soon, I still think is it will be challenging for some of the reasons we'll get into. But that's sort of where we are at the moment. That sheer, suffice to say, the global economy presently is in depression, and things will improve, but it's probably likely to still be in recession rather than depression. And looking at the situation with regard to the virus itself, firstly, just a chart there of this is a death rate, so it's the actual daily moving average of deaths amongst a number of countries. And as you can see, look, we are past the peak in terms of developed countries in particular, but they are the new cases and death rates, particularly in the United States, which after all is still the most important economy in the world, is still up there. It still hasn't flattened off in the way it has in China or in the way in Australia, for example. So there is still even a lingering risk in the US, and obviously they have started to reopen their economy. Certainly some of the southern states have been very keen to reopen their economy. And so they are then, still exposed to a potential, flare-up in cases. So really, let's open up and see what happens, because, and it's almost, the nature of democracies, you can't keep people locked up forever. And so it's almost, they're taking a risk of the infection rate picking up again. because that's the only way they could really justify, having to shut down their economy if need be. And just in terms of what's been going, so this is a slide. Again, those lines are basically measures of the restrictiveness of policy and a number of different countries. And so, full complete lockdown, the indicators are quite high. And as you can see, across a number of countries, they were ratcheted up over February, March, and into April and May. They are now starting to come off, so there has been a lessening of those policy restrictions. The restaurants are opening up and bars to some extent, people being allowed to travel, schools reopening. But it's still gradual, and it's still fairly uneven. And so even in Australia today, like I travelled in on the train to work today, and I would say it's 15% capacity still, so very, very low. Certainly things are better than zero, but it's still very, very low in terms of capacity, and this is what we're seeing around the world. And that's going to, frustrate the global recovery as well, because a lot of countries, this is a global, coordinated, synchronized downturn. So no, everyone can't, we sort of can't rely on exports from other countries, because we're all sort of in this together and all quite weak at the same time. Nonetheless, if you look at the share market, so this is a chart of the S&P 500 index, and as you can see, it's been a pretty impressive rebound from those lows in late March, and there've been a few stages of stabilisation, but it's just continued to keep pushing on, and only this week it's pushed on to new highs. Sorry, not new highs, but pushing on through the range that it's been in for the past couple of weeks, so a breakout. Now, can it go all the way back to the peak? Possibly, you can never, but I still think the market is starting to get pretty stretched here in terms of valuation. So the US market now trading on around about 21, 22 times forward earnings. And my expectation is that earnings will continue to fall as analysts revise down their outlook. So even if the market doesn't go up any more from here, it will trade at even higher valuations as earnings fall. So we're looking at the US market possibly returning to valuations in terms of outright PE not seen since the dot-com bubble of the late 1990s. Now, the big difference, of course, is that interest rates are a lot lower than they were then. So US 10-year bond yields are at 0.5%. So arguably that justifies a somewhat higher valuation, but it's still very, very, very stretched. And just going back to this is a chart from the recent Reserve Bank quarterly economic forecast. And as you can see, they've got various scenarios for how the economy is going to pan out, but their base case scenario still has growth, well below the trend path that it would have been on without the virus, even with some recovery moving into 2021. And the unemployment rate, as you can see, it's now only 6.2%. Likely to head up to about 10% or so over the next few months still, and even this time next year, yes, come down, but still be uncomfortably high in around about 7.5%, 8%. So even the base case scenario of the Reserve Bank, even is still for a fairly subdued recovery. And again, just going back to the arguments here is that even if we don't get well, in fact, I'll go to this now. I mean, one of the concerns that will be holding, I think, keeping consumers cautious and business cautious is the risk of a second wave. And again, we don't actually need a second wave. We just need the fear of a second wave to cause businesses to be cautious in their investment plans, their rehiring plans, because, effectively at any given moment, we could get a flare up in this virus and governments will be shutting down the economy again. So that's a very hard environment in which businesses can plan for the future. So you would expect that business investment plans won't go back to anywhere near what they were prior to this crisis. And we really ultimately need a vaccine before we can really get past this crisis. And again, most experts suggest that's still 12 to at least 12 months away. And historically, every pandemic since the 1918 Spanish flu has had second waves we saw that in 1918. We saw it with the Spanish and Asian flu in the 1560s. We also saw it with the swine flu in 09. Of course, swine flu and the other influenzas since 1918 haven't been as severe in terms of the death rates. So economies haven't needed to be shut down. But this virus, as we've pointed out in the past, is probably the worst since 1918. So a major flare-up would be sufficiently worrisome that you could see economies or parts of the economy shut down again. So in terms of bonds, why bonds? And just again to highlight the features of bonds as an asset class before we talk about the specifics. So a bond, as you may know, is really it's a security that offers you a regular income payment, a promise of a regular income payment with your principal given back to you at the end of the term. So you buy a bond and it'll give you, subject to the interest rate, a regular payment of income on a monthly or quarterly basis. And then when that bond matures, be it in 3, 5 or 10 years, you get your principal back, unless the entity that's issued that bond, be it a government or a corporation, has become, bankrupt essentially. And so, buying a bond, you do have that sort of credit risk, but again, it's a lesser risk than if you're an equity holder. For example, if a company goes bankrupt, shareholders get wiped out before bondholders. So if there's any money left, it goes to the bondholders before the shareholders. So that's the something important. And again, that comes to the quality of bonds as well. Government bonds are less risky than corporate bonds because government bonds, governments, unless you're talking about Argentina or Brazil, are less likely to default typically on their bonds vis-a-vis a corporation. So in terms of the benefits of bonds, income reliability. As I said, the income payments you get from bonds, be it through a bond ETF or a bond directly held, are more reliable than dividends. We're seeing that at the moment, where some companies, because of the impact of profits, have cut back their dividends, but they haven't cut back the payments they're paying on their bonds, because that would be, a more serious, transgression of their commitments, and effectively would be a default situation if you couldn't pay back the income on your bonds. Return stability, so the overall, and a bond, certainly if you're buying fixed income bonds where the market value of those bonds is subject to interest rates. So if interest rates go up, typically the market value of a fixed rate bond goes down, and vice versa, because as interest rates go up, the bond needs to trade at a lower level to give you effectively a higher yield on that bond for the given nominal payments you're getting from that bond. But the volatility of those returns is still quite significantly less than for equities, as we'll see. So overall volatility of returns are less when you own bonds. And the other useful feature of bonds is that of portfolio diversification. So not only are the returns of bonds, the volatility of bonds less than of equities, but it's negatively correlated typically. So when equities are doing poorly, typically you see interest rates falling, bond yields falling, and the market value of bonds going up, and vice versa. When equities are rallying strongly, typically interest rates are rising and the value of bonds are going down. So you're getting that negative correlation, which is very useful when you hold bonds alongside equities within your portfolio. Just to show you here the relative volatility. So I've got a chart, and this is the annual returns from the ASX 200 index in the dark line, and then the annual returns of, I guess, the plain vanilla benchmark index for Australian bonds in Australia, what's called the Bloomberg Ausbond Composite Index. It's basically an index that tracks all the bonds issued, investment grade bonds issued in Australia by either corporations or companies or governments, federal or state. And as you can see, the annual return volatility of that index is significantly less than for the equity market. Not only that, as you can see, when equities are doing particularly strongly, the return on bonds is relatively less, and vice versa. So you're getting that negative correlation. And that is actually highlighted in the next slide. As you can see on the first slide there, you've got the annual returns of the Australian equity market vis-a-vis annual returns of that bond index. And broadly, there's a negative relationship there. Just goes to the point that I mentioned before. Not only that, that return really comes to the fore when you get periods of equity market sell-off. And so there's the second chart there, are periods where the equity market has sold off. Bonds have really delivered. Well, certainly held up quite well. So the Ausbond Composite, and more recently, as you see, equities, at their lows were down quite significantly, and bonds actually held up pretty well in price. Now, so that's the case for bonds in general, and then more specifically, again, you can buy different types of bonds. You can buy corporate bonds, you can buy government bonds, you can buy short duration bonds where the term to maturity of these bonds is, let's say, only 2 years or 3 years, or you can get longer maturity bonds where the basically the term to maturity, or the time in which you get your capital back, is a lot longer. And we would argue that, again, the ETF that we'll be talking about here is actually distinguished by the fact that it invests in longer duration bonds, and not only that, but typically high quality government bonds globally. And the beauty of longer duration bonds over shorter duration bonds is that, firstly, you get a better yield, because the longer a duration of a bond, the more sensitive is its market value to changes in market interest rates over time. So for that extra volatility, the market rewards you in a sense by giving you a high yield. So all else constant, longer duration bonds give you a high yield. Now, but the beauty of that, the fact that there is a sensitivity in the bond returns to interest rates, adds to the diversification appeal of those bonds. Because again, going back to that point I made before, typically when equities are doing poorly, interest rates are falling, and the value of bonds are going up. And in fact, the value of longer duration bonds goes up by even more because it's more sensitive to interest rates. So the diversification benefit you get from holding bonds within a portfolio alongside equities is even better when you're holding longer duration bonds. So you're getting paid for something that actually gives you good diversification within your portfolio. So that's really the case for long duration. And last but not least, higher quality bonds. So again, the ETF we're talking about today invests in only government bonds issued by major industrial countries. And the benefit of that, certainly in a risk-off environment where, say, economies are going into recession, is that government bonds tend to do better than corporate bonds in that environment, because again, the risk of default on corporate bonds, on government bonds, is less than that of corporate bonds. So all else constant, government bonds of a certain maturity, term to maturity, will do better than corporate bonds in a risk-off environment. So that's the unique characteristics of I guess the type of bonds that this ETF will be providing exposure to. Long duration bonds giving you better yields than what a simple plain vanilla type indexed bond exposure would give you, and focused on higher quality government bonds within that exposure. So with that, I'll hand over to my colleague Mai, who will go through a bit more detail this ETF.
Thanks, Dave. So as we mentioned, we will be talking about today the BetaShares Global Government Bond 20-year ETF, ASX ticker GGOV. As David mentioned, this is certainly adding to the BetaShares fixed income suite. So here is just a table of the summary characteristics of some of our other fixed income funds that we have. I won't go through the table here, but you'll be certainly receiving this in your slide deck. With GGOV, it really does continue the BetaShares strategy of providing fixed income building blocks for our investors. So what this chart here is showing is exactly where each of the BetaShares fixed income funds fit from an interest rate and credit risk perspective. So depending on what you're looking for in your portfolio and what you're looking for your fixed income exposure to achieve, we certainly have a fund within that spectrum. As David mentioned, so GGOV is a long duration global government bond index. So if we take a look under the bonnet a little bit here, so it is exposure to the fixed rate government bonds issued by G7 nations, and these member countries include USA, United Kingdom, Japan, Germany, France, Italy, and Canada. So on the longer duration profile side, it has a maturity profile about 20 years. It holds 131 bonds. And what you see here is that the country weight is duration capped at 25%. What does that mean? So that means that the country risk of any of these countries in this fund is limited to 25%. And also the fund is currency hedged as well. management cost is 0.22% per annum. So as I mentioned here, so on the index characteristic side, it is fixed rate bonds from the G7 nations. It is exposure to local currency bonds issued in that domestic market. The issuances are weighted according to market value, but adjusted, as I mentioned, to ensure that no country contributes more than 25% of that duration risk in the portfolio and currency hedged. So if we take a little bit of a closer look here, so as you can see, the country allocation you're getting in this fund, it is mostly US, Japan, United Kingdom, and it's very high credit quality, which you can see on the right hand on that pie chart. And then we've just included here the top 10 index exposures. So from the various European governments there that you can see. So the question here is, why would you invest in GGOV? So as David mentioned, the high credit quality. So in this scenario, the credit quality of government bonds becomes very important in a risk-off scenario. So generally speaking, the higher credit quality you have in the portfolio, the more you're getting compensated from a yield perspective. On the diversification and defence area here, as David mentioned, government bonds historically have tended to perform better in periods of equity market weakness because they are seen as a more secure exposure. And then on the income side, you are getting income, so you are being compensated for taking more of a longer duration view in the portfolio, which means that the income potential is higher than for other bonds that don't have such a longer duration profile or a high credit quality profile as GGOV. So here we've just summarised the yield and maturity characteristics. So current running yield here is 1.81%. So it is higher than what you're getting in the cash environment. Again, average maturity there is currently 27 years. We're targeting 20 plus years and very high credit ratings, so AA. What we show here in this table is the breakdown of the index that GGOV tracks by its credit rating, comparing it to two of the broad market benchmark indices, which is the Bloomberg Global Aggregate Index and the Bloomberg Treasury Index. So what we're showing here is that in GGOV, which is the pale orange bar there, you are getting more exposure to higher quality credit assets. So we're looking here at 38% in AAA and AA at 32%. So again, you're getting more exposure to higher credit quality than the lower credit rating exposure. Here what we're showing is the defensive nature of GGOV in times of market weakness. So GGOV's index is in that orange bar here. We've got the MSCI All Country World Index in the dark grey bar. So again, what it is highlighting that it has performed very well in equity market drawdowns compared to the Global Aggregate Index and the Global Treasury Index. And the reason why GGOV has performed so well in these periods of market stress has been that it doesn't have corporate bond exposure, which can sometimes be affected in these periods. So basically, things to consider here is investment risk. So of course, in a situation in an investment in GGOV, the fund can go up, can go down in value. And there are also risks with respect to interest rate sensitivity, credit risk, country risk. Again, outcomes may or may not be achieved. This is general information only. Our investors should seek professional advice. And for more information, please see our PDS. So we've gone through that quite quickly. So we'll just have a look at some of the questions here. I'll just have a look. So a question here from one of our attendees, Dave. Recently, stocks, bonds, gold, all moved in the same direction. Is there any point in diversifying in a market of this sort?
Well, so why did they all move? Basically, what they're all trading on is monetary stimulus. So you've got central banks, throwing the kitchen sink at the problem. So the Federal Reserve has everyone slashed interest rates to zero. They're partly monetising government debt to keep a lid on bond yields. And so that is positive for bonds. The yields going down, as we said, increases the value of bonds. Yields going down also it helps support high share market valuations, so it's supportive of the market, and also that monetary stimulus supportive of gold. So look, in certain economic environments, asset prices can move together, and that's what we're seeing now. In different market environments, they'll move differently. But yeah, at the moment it's a risk-on trade, and everything is benefiting from central bank monetary stimulus. Now, at some point, central banks will take away that stimulus, and/or there'll be a general more risk-off move, in which case you might find equity. People worry about valuations, equities sell off, and bonds don't. So different things can happen, but. It's a good question, but that's the sort of situation at the moment. I still think generally it does make sense to have, your foot in different camps because anything can happen in terms of, market environments over the long run.
Thanks, Dave. So another question here. With interest rates so low, and when interest rates go up, is the bond value therefore likely to decrease? If this is correct, why would we invest in bonds?
Look, of course, bond yields at the moment are relatively low around the world, so that is true. And so if bond yields were to rally in a big way, the absolute return on the bond, at least in terms of price, would go down. There's no question of that. So if you are particularly bearish on bond yields and you think they're going to head up in a big way over the next year, then yes, you'd probably be cautious about investing in bonds. So my couple of points would be still within, again, that's assuming 100% foresight. But the idea of a diversified portfolio is that you're never quite sure what can happen. So again, if you held bonds and bonds did sell off, it would probably be an environment where equities are doing quite well, so you get that diversification. And if you're wrong and equity and bond yields stay low and in fact go lower, they have gone negative in some countries in the past, then bonds can continue to deliver a return in an environment where equities may well sell off again. So the point is not, it's more of a broader diversification story rather than a tactical, should you be overweight, underweight bonds at this particular moment. It's just the beauty. And not only that, it's that if you are going to have bonds in your portfolio, then the advantages in this, again, there are different ETFs giving you different types of bond exposures. What we're highlighting here is the benefits of a bond exposure, which is longer than the typical market index exposure, longer duration for those benefits of extra yield and diversification, and government bonds, so that if things do go badly and corporate bonds underperform government bonds, then you benefit from that as well. So that's the case we're making today.
Thanks, Dave. So I think we have time for one more question. Will you please explain what you mean by greater yield sensitivity? I think we're talking about interest rate sensitivity here. Means return correlations with equities tends to be more negative when compared to shorter duration bonds.
Sure. Okay, so I'll just walk you through this. So if you imagine a bond that has a 10-year term to maturity, so if you buy a bond today and you don't get your money back for 10 years, but you're getting paid regular income over that 10-year period, and say that income is $100, and the principal you get back at the end of 10 years is $100. So you're getting $10 on that bond. It's like a 10% yield. Now, if interest rates go down, so say the market only requires you to get an 8% yield. Say the competing bonds come out and they're only offering 8% yield. All of a sudden, the fact that you're getting $10 on that $100 bond, 10% yield, it's a lot more attractive. So what would happen is the market value of that bond would go up. So that bond, if you were to resell it, would go up from $100 to whatever it might be, $110 or whatever, such that the effective yield you're getting on owning that bond has fallen from 10% to 8%. Now the benefit of, and again, the beauty of that is that the market value goes up by more depending on how long that stream of income payments are. So if you're getting that stream of income for only 3 years, so it's a 3-year bond, then the sensitivity of the market value of that bond to that change in interest rates is less than if it's a 10-year bond. So and again, the technical term for this is called duration. So for example, if a bond has a duration of say 4, it means that a 100 basis point change in a bond yield, say goes from 3% to 4%, will change the bond value by 4%. If the duration is 7, then a 1% change in the interest rate, in this case, say 3 to 4% or whatever, would change the market value by 7%. So that's point one. The yield, the price sensitivity of the bond is greater when the duration of those bonds is longer, as is this ETF. So it's got a term to maturity of these bonds is like 20 odd years, so much longer than if you were to just take a market. If you were to just have an ETF that invested by all the bonds issued rather than just bonds of a very long duration. So again, but that sensitivity has 2 benefits. Firstly, you get paid for that duration. So the yield by having longer duration bonds is higher than short duration bonds. Secondly, given that interest rates typically go up when equities go up and vice versa, you're getting that negative correlation. So again, go back to that example, if bond yields go down, the market value of the bonds goes up, typically that'll happen when equities are going down. So you're getting that the negative correlation is there. And because longer duration bonds, their prices go up by even more than shorter duration bonds, then that negative correlation with the equity market is even greater. So that's the point. So you're getting long duration bonds give you better yield plus a higher negative correlation with the equity market over the cycle. Because it's greater sensitivity to interest rates. So I hope that's clear, but that's that's sort of the case for long duration bonds.
Thanks, Dave. So we do have a number of other questions, but in the interest of time, we will get those questions answered to you directly. So we'll send those to each individual who's typed that through. But again, thank you everyone for your time today, and I hope you found that useful. As I mentioned, we do have a lot more information on our website with respect to the case for GGOV and also on fixed income more generally. Again, thank you everyone for your time, and we hope to listen to you again soon.